Hi, I'm Roger Aguinaldo, and welcome to the M&A Advisor podcast. Since 1998, the M&A Advisor has been the definitive source dedicated to recognizing achievement, delivering unrivaled thought leadership, and connecting the world's mergers and acquisitions elite. We help you sharpen your edge and accelerate your success in deal making. Whether you're an ambitious new player or a market veteran, this podcast provides masterclass strategies, unvarnished stories, and vital lessons from the industry's influential figures. Before we launch into this episode, be sure to follow us on YouTube, Apple Podcasts, and Spotify, and subscribe to our essential M&A Alerts email newsletter. Find all the links below. Your engagement fuels the deal-making community. Now let's get into the transaction.
I'm Tom McCabe. I'm a Senior Managing Director with GlassRatner Advisory Capital. And I'm very excited that my former project teammates are here to talk about a great transaction we worked on over the course of about 2 years. Sam Newman from Sidley Austin, partner right here, who is the leader of the project from the beginning to the end. And we have Neil Gupta from SSG Capital, who was the lead M&A advisor. And I served as Chief Restructuring Officer of the project. Because we deal with a lot of really boring products in our world, I'm in the Midwest, so I deal with, my friend Tom Goldblatt's here, we deal with a lot of widgets and boring things. This was a really cool product that had an unfortunate ending. We're gonna show a couple slides to give you a little background, and then we're gonna talk a little bit. So, if you will. So Icon Aircraft was a company based in Vacaville, California, which was an amphibious aircraft company. Thank you. And what we're going to show you, we just have a handful of slides. We're going to talk about the transaction from beginning to end, but in particular, we filed a Chapter 11 in the middle of this. And for opening day hearings, we wanted the courtroom, the judge, the stakeholders to get an understanding. We just are going to give you a few slides to give you a little background. So let's see. This is the cool product I was talking about. Let me get out of the way so everybody can see. Essentially, and Neil and Sam could probably do better justice, it's a 2-seat amphibious aircraft, very lightweight, can fly a fair amount of distance, and can also serve as a boat. Some people call it a boat plane drone. Can everyone hear me okay without mic? So anyway, a pretty cool product, funded probably in 10, 12 years ago, and had a great track record, raised a great deal of VC and PE money, and had a great beginning. We're going to talk about a very, very highly distressed transaction and all the nuances of that.
Can they click on the button and show the video? If they're on the side? There you go.
Okay. There we go.
That's what we wanted.
Ladies and gentlemen, this is your captain speaking. Feel free to put your arms outside the windows and enjoy the flight. Direct to Nassau. Let's head out to sea. Look down. We have dolphins. There they are, jumping.
That's amazing.
Is this live now? So a couple sidebars before we get going with the Q&A. Number one is if anyone here happens to have $999 cash, we can sell you a refurbished Icon A5 aircraft if you'd like. Tom, would you like one at a fire sale? Number two, and this speaks to the coolness of the product and my identity. When we closed this transaction, the day we closed it, to celebrate, I was on site with the CEO of the company, who happens to be a former Navy pilot. And this is my quick sidebar before I get to the substance with these two guys. They asked me if I wanted to fly in the A5 with the pilot. And I said, of course, that would be really cool. You know, it's a good way to celebrate the transaction. And then they asked me how much I weighed. And you guys can tell, I'm built like a jockey, 99 pounds. And they said I'd either have to fly by myself or with somebody who weighed a pound. So I never got to fly the A5. Anyway, so before we get going here, Sam, a little bit about your background, please.
Sure, thanks, Tom. My name's Sam Newman. I'm a restructuring partner with Sidley Austin. I'm based in Los Angeles in the Century City office, and I've done, over the last 25 years, I've been involved in a lot of Chapter 11 and also out-of-court restructuring transactions, particularly involving tech, life sciences, and other kind of West Coast-based companies.
Hi, Neil Gupta, SSG Capital Advisors. We're a middle market investment banking firm based out of Philadelphia. Do focus on M&A transactions and refinancings and restructuring assignments across all industries. SSG stands for Special Situations Group, so we exclusively focus on companies going through some form of inflection point, primarily distressed companies, so no specific industry focus, but a lot of deals that are effectuated through a bankruptcy transaction or out-of-court foreclosure or some other form of asset sale.
Again, Thomas McCabe at GlassRatner. For about 25, 30 years, I've worked as a lead in restructuring turnaround, KPMG, BDO, and now GlassRatner. During that time, have often been fortunate enough to serve as chief restructuring officer in Chapter 11s and transactions related. So my background is on highly distressed deals. And with further ado, Sam, I thought maybe you could please open up. Sam was the first pretty much outside professional involved when the distress hit Icon aircraft, and maybe talk about, you know, your role and what you saw in the early stages that led to an eventual transaction, please.
Sure. So, you know, we always in our business like to complain about not getting involved early enough in transactions. This may be the only time I ever wanted to complain about getting involved too early. We started advising the company after they were invested in by a Chinese fund. The founder of the company had conceptualized the idea of this light sport aircraft that was going to utilize high technology graphite composite manufacturing and combine it with state-of-the-art avionics into this dual-use runway and water landing aircraft. He went out to market. He got investment from a Chinese investment fund, which almost immediately became kind of a sour relationship. I think his view was that he was going to take this investment money and be kind of left alone to do his magic. And I think the Chinese fund's view was everybody at the company worked for them. And that was just an incompatible worldview. And so almost immediately it became difficult for them to start raising additional capital on what was essentially kind of a long lead time to commercial viability for this product. So the M&A team reached out, got me involved. We were able to kind of work on what essentially was a corporate counseling project over about 4 years, trying to help the company understand what their various buttons were they could push to raise money, both equity and outside capital, and what the various opportunities would be in the event of a restructuring or liquidation. And so we did work through that over the course of many years, during which it was a pretty, if not dysfunctional, differently functional governance relationship. I mean, some of the board matches really did, degenerate into shouting matches, and not infrequently. And so by the end of 3 or 4 years, it became clear both that the capital structure was unsustainable and that the partnership really was not going to survive long term. And so by the time we were able to start thinking about what were some exits, including what ultimately became a Chapter 11 plan, I had been working on this project for almost 3 or 4 years.
Shift over to Neil real quick. So at one point, Sam and the lead professionals and the board decided to bring in a professional M&A team, hired SSG and Neil on point. Neil, maybe talk a little bit about your transition when you were hired, what you saw, what you inherited, some sort of the challenges, and we could talk about this from 99 different ways, but in particular the cross-border challenges of dealing with potential Asian, European buyers in addition to U.S. domestic buyers might be interesting.
Yeah, sure. So SSG was engaged probably about 6 months prior to the bankruptcy filing, which happened in April 24. At the time, the Chinese investors who had put in a few $100 million, PDSTI was the name of the firm, they were looking for an exit. They had put in a lot of money already, and they were hoping for some form of a transaction, whether it was highly structured to get them some return in the future or just a cash offer. They were trying to see what the market looked like for the assets. So we went out broadly to a couple hundred parties. The thing, and as cool as the product looks here, and as much as it seems like something that should have high demand, the demand was relatively limited and to some extent capped in the U.S. at the price point they were at. The business model, I wouldn't say it was a failed business model, but at least in the U.S., when they initially were designing the Icon plane, it was supposed to be a $200,000 plane, but when it came to all the parts and engineering and everything else that went into it, it ended up being more of a $400,000 plane in order for them to make any money off of it. And while they had thousands of orders to start with, when they thought it was going to be a $200,000 plane, when it became a $400,000 plane, it became much more limited. So they were selling about 30 planes a year, but really needed to sell over 100 planes a year in order to make money. And there just wasn't the demand for that in the U.S., and it wasn't certified to be sold outside of the U.S., and that was really where a lot of the growth was. So while we were going out to a lot of domestic potential buyers, there wasn't a great U.S. business plan. It was putting in $30-40 million more dollars and hoping that the market kind of shows up and maybe you're able to get some international sales. Where we really saw interest was more from international buyers who saw a business plan that included, whether it was China or in Europe or other countries, a way to sell both domestically and internationally, pursue those certifications, and cut down the costs too, because all the manufacturing was done in Mexico and the U.S. There were other countries out there where you could build this a lot smaller or for a lot less capital, and then hopefully be able to generate more sales that way. So. It was a challenging sale to start with, and then, aside from that, it's trying to find buyers in multiple continents is also challenging. A lot of the other competitors of Icon were also companies that were in somewhat startup mode. They, had raised a few $100 million, but could see this as another product in their portfolio. So they, we're vetting not only for wherewithal for, I guess 3 issues: finding the companies wherever they might be in China, in Europe, in Australia. 2, it's vetting them to find out if they actually have the capital to do a transaction. And then 3, seeing if it was feasible to do a transaction just based off of all the regulations, not only in the U.S., CFIUS in terms of getting investment from other countries, but also buyers in whatever country they are, if they can get money out of that country to buy a company in the U.S. as well. So that was the whole, I'd say, the pre-petition process, where we worked with a couple buyers for a long time to find somebody who could replace PDSTI, the current investor, but ultimately couldn't get to a deal that made sense. And that's when it pivoted to PDSTI deciding that them, through their affiliates, would want to effectuate a deal through a bankruptcy process.
Before I get back to Sam to continue the challenges and things we face, just at this point, kind of taking Neil's story, I was appointed Chief Restructuring Officer and inherited everything you've heard. And just, this gets back to a little bit what my friend Tom Goldblatt spoke about this morning for those of you here. But, we focus on the legal, we focus on the risk management, we focus on the transaction, but you're also running a concurrent operation to keep it viable, to the best of your ability. Whereas my job would be to keep the equity in play, to keep the value in play for the professionals. And we had a lot of really unusual things happen. As Neil mentioned, company was headquartered in Vacaville up towards Northern California. All the manufacturing was done in Tijuana, which had been done, as Neil mentioned, the pricing to reduce the price point to get to a margin that never occurred to make it a successful company. And there were issues in Tijuana from the beginning. Anyone that's dealt with, we're talking about cross-border M&A, but I'm talking about cross-border operational issues. The manufacturing in Tijuana from the time I was hired was a problem in that I couldn't get to Tijuana because we had people literally with weapons trying to keep the Americans from getting into the facility in Tijuana, number one. Number two, quick side story, and we've only got about 20 minutes, and I want to allow room for Q&A, but at one point, famously as part of our project, I got a call from either Sam or one of his partners that these aircraft were being taken out of the facility in Tijuana and stolen. So we literally had to have Sidley draft a document telling them that the U.S. government, something, says you have 24 hours to get the aircraft. We're trying to protect the assets and the equity at this point. But that was a little crazy. That was one of many crazy stories about keeping the operations alive and viable to an eventual filing. And the issue there was, had the facility been in the U.S., which was not realistic and reasonable, we wouldn't have had those issues. But from the beginning, the issues of the manufacturing operations were a problem throughout the whole process. So I just wanted to throw that out there because, again, we're focused on the transaction. But the problem of a transaction is you have to keep the company alive and breathing, which was kind of my role, custodian of the assets, maintaining some sort of viability to get to a transaction for the professionals. And so I'm going to turn it back to Sam to kind of, we hired SSG, Neil. We had some people in the red zone, or the long red zone, looking at it. We certainly had the original equity large debt holder from China as a likely, I'll say probable, potential buyer. Maybe let Sam take sort of the process from there a bit, through an eventual Chapter 11 filing.
Yeah, so when you have this kind of dysfunction in the governance, you're unable to bring in new capital, right? Both parties in this case, and it's not atypical in these closely held companies, had some level of veto right over fundraising, whether it was debt, equity, et cetera. Even a sale would require some cooperation between these two parties. So it became clear, probably a year before we ultimately filed, that the company was going to run out of money if there wasn't new capital invested. And the two warring factions within the equity were going to be unwilling to collaborate in order to allow that to come in. So we devised a governance structure. Typical to what we do in the restructuring space, we recruited an independent member of the board who was sort of a restructuring advisor. We had Tom's team brought in to help facilitate operational management and basically convince the majority shareholder, which was the Chinese investor, that their interests would be best served by relinquishing some level of control in order to allow things to actually happen. That allowed them to step into the role of bidder, essentially. And so their main role, once we got to this point, was to make a proposal to purchase the assets through a Chapter 11 case so that they could put some certain amount of money out on the table. If that were the highest or otherwise best bid, they would then be able to buy 100% of the assets outside of the control of the minority and then go on to be able to run their business. But that would require both independence in the governance, so that's why we brought in the outside director, and a Chapter 11 process, A, to allow them to put more money in the short term through a debtor-in-possession financing facility, and B, to allow them to ultimately make a bid, both of which would be blessed by a court as being the highest and otherwise best opportunity for the company under the circumstances, which allowed them both to kind of avoid the blocking rights of the minority and also to avoid any follow-on litigation over the propriety of either the financing or the sale transaction. And so, with that structure in mind, the insider investor invested, another, I want to say almost $10 million to fund professional fees and operations during the sale process and ran a sale process under Neil's supervision that ultimately identified one other bidder and resulted in an active, robust auction that came to a price which ultimately the court approved. And so timeline-wise, we prepared for about 3 months, hiring and bringing on all the advisors that were needed. The bankruptcy case ran for about 3 months of a sale process, and then the sale was closed, and we transitioned into the final phase, which was the plan negotiation. But we can kind of pause there so that we can talk a little bit about the sale process and anything else, Tom, you want to cover.
I want to pivot back to Neil, but just, a lot of times when we talk about M&A and transactions, we forget about the blocking and the tackling and the, just the basics, which is preserving cash to keep it alive through a bankruptcy filing, which can be a little expensive for anyone that's done a transaction concurrent with a Chapter 11. And my job was to do literally a day-to-day, including Saturdays and Sundays, cash flow to make sure that we could keep the company alive and breathing, but also to fund through a Chapter 11 filing and concurrent eventual sale that Neil oversaw. So I just think it's important. And again, back to the topic at hand, which we could have named this, again, 300 different topics, but just basics like maintaining cash and getting cash from a Chinese potential buyer dip funder who's using their European operations to get the cash. This sounds silly, but Neil and I were literally checking accounts with attorneys to make sure that we got the cash by deadlines. I mean, little things like that people forget during a transaction that are critical, that if you stumble, will trip material major obstacles for which we'd have to go back to Sam and his team and say, now what? So again, just things like that, challenges. It's a lot easier if you're dealing with a potential buyer that's in San Diego or in Bangor, Maine, but when you're dealing with, an Asian or obscure European buyer, it just creates complexities on the basics. Neil, I thought maybe you could take it a little bit. Sam mentioned the eventual sale went to an auction, which was handled about 12 blocks from here at the Sidley offices. We didn't know who would show up. It was an open auction. We knew the potential Chinese buyer would be there with 3 representatives, which was interesting because we had translators. We didn't know who else would show up, but I thought it'd be interesting to talk briefly about who did show up and how that created a little, led by Sam, the auctioneer, by the way, led to a little bit of a bidding that got to an eventual sale. Might be interesting to talk about that.
Sure. So ultimately, the Chinese investor that we've been talking about, as we mentioned, they were using a couple different entities. So first off, they used another Chinese affiliate to provide what's called the debtor in possession financing, DIP funding in the bankruptcy case, and that's what Sam talked about. I think it originally started at $10 million, ultimately ended up being $15 million they put in. So this is a senior loan they put into the company here. And then, normally what we see in bankruptcy cases is that DIP lender ends up being the buyer as well. In this case, the Chinese investor decided to use another entity, a German company that they had a majority stake in, to be the buyer. So it wasn't technically a credit bid of that DIP loan. It was more just a third-party bid from a German investor. But the German investor ended up submitting a qualified bid, which essentially bought out the DIP loan in whole and maybe paid a little bit more on top of that.
And if I can just jump in
Sure.
real quick from the legal perspective, one thing that we talk about a lot when we're advising clients, but just to keep in mind, given the insider relationships of the new financing party and who ultimately became the buyer, there were a lot of objections from other parties that could have resulted in litigation outside of a bankruptcy over that relationship. And the bankruptcy process really afforded us an opportunity to keep the transaction on track and not keep getting derailed by these constant allegations of self-dealing.
Right.
Real quick, I want Neil to continue, but I actually want Sam to spend 2 or 3 minutes talking about that challenge because, again, a major strategic, I'll say objection or challenge that Sam and the team and I had to navigate through to get this transaction was maybe talk a little bit briefly about the DLP, the derivative action, and the original founder of the company who was creating a challenge. Might be interesting.
Yeah, I mean, just 2 seconds more, right, on that same topic, but one of the things in other transactions that's probably, cross-applicable is this relationship had so degenerated into infighting and even, in fact, active litigation. There was he referred to the DLPs, there was a derivative action that had been filed by the minority investors to try to enjoin various aspects of this transaction prior to the bankruptcy filing that would have made it probably impossible to consummate this transaction outside of a bankruptcy. And so bankruptcy became a very useful tool to address a bunch of tactics, but all the fundamental strategic dispute was these insider shareholders fighting over the direction of the company. So for many of the folks in the audience who are not full-time bankruptcy people but are M&A and deal with healthy transactions, this mechanism allowed us to kind of keep the transaction on track and close it within a reasonable timeline, better, we thought, than other potential litigation.
Practice, Neil, maybe from auction, term sheet, agreement through closing, you and I worked very closely to ensure that got to a closing, if I remember right, April 30th, 2024. And I'm sitting in a conference room in Vacaville with fingers crossed and counting assets. Maybe talk about that process, some challenges maybe to get there.
Yeah, sure. So I guess just closing out the auction itself. So we did have the one, call it German buyer, who's not technically an insider, but we treat it as an insider for purposes of the bankruptcy case. And then at the last minute, we actually did get a second bidder. And this, to some extent, was I wouldn't say an affiliate, but probably more supported by the founder of the company. So on one side, we had a company who everybody thought might want to move the assets to China, move manufacturing and the assets to China. On the other hand, you had the potential savior, a U.S. representative who was affiliated with the founder of the company. And we, as Tom mentioned, had a robust auction with a few different rounds, multiple rounds of bidding. And ultimately, the Chinese investor was the winning bidder at the auction. We actually, even though the physical auction ended on that day itself, we kind of left the auction open up until the sale hearing where it would be approved. And we had further bidding after the fact. The American investor came back to us a day after the auction itself and said they would increase their bid to match the Chinese investor. And it's always much more complicated than just comparing cash versus cash. There's the risk to closing, everything else that goes into it. But ultimately, we had the sale approved with the Chinese investor and their affiliates. From there until closing, and the biggest issue we ran into in terms of trying to get to closing were the approvals that were required. We had already cleared everything that was necessary from a CFIUS standpoint. So we did not need to file anything for money coming into the U.S. from a foreign entity. It was more that even though it was a German company buying the assets, a lot of the capital was still coming from China, and they have their own. The Chinese government has what's called the ODI, where money coming out of China into the U.S. or other countries has multiple layers of approval that are required in China. And so we at least had to get through one or two levels of that prior to closing. And that kind of held up closing, kind of an uncertain timeline to get to closing, but ultimately we're able to bridge that.
Yeah, I'll just note also, it's a very good point from a legal perspective and kind of cross-applicable for cross-border M&A. Right now is a very difficult time for certain cross-border transactions, and we kind of ran into that in this transaction. I think things have actually, from what I've heard, gotten even a little more strained. CFIUS, the Committee on Foreign Investment in the U.S., has been very carefully reviewing, even more so I think than a lot of people are used to, transactions involving inbound investment into the U.S. from certain jurisdictions, China in particular. The various trade and export control regulatory agencies are very carefully monitoring transfers between the U.S. and other jurisdictions that are considered national security threats. That's more complicated now than it has been in the past. And then in response, many foreign jurisdictions are implementing their own controls. And so we ran into that. China has this Office of Direct Investment, ODI, which specifically has to approve each individual investment of cash dollars over some threshold outside of China. So all three of those regulatory regimes were in play here and really created significant timing constraints for this transaction and other investments. So it is something that's a very hot topic right now, and we relied heavily on the Sidley foreign investment practice to help advise us, but a lot of large law firms are very active in this space right now. It's important to get out ahead of if your transaction has any timing components.
As we sort of wrap up, we have 10 or 12 minutes, and I want to allow just a couple minutes for Q&A at the end, and please find my good friends and former Project Icon teammates, Sam and Neil, if you have questions, follow up, whatever, because I think we could go on all day. As you can tell, this is not a shy crowd. We're pretty gregarious, so I think we have a lot to talk about in this project, but we're going to sum it up real quick here with a couple things. First of all, I'm just curious, raise of hands. We have deal makers in the room mostly. Who here has done a transaction, besides the three of us, which we've done many times, concurrent with a bankruptcy filing, a Chapter 11? Tom Goldblatt, for one. Anybody else? So again, it creates so many extraordinary challenges and obstacles that we've talked about just touch the surface that we live with day to day, 7 days a week. And just to sort of close up the story from Sam and Neil, even post-transaction, as Neil and I and the team and the attorneys from Sidley were working on to get to closing and post-closing, once you close the transaction, you still have to get the transaction sort of approved by the Chapter 11 judge, right? In this case, it was Thomas Goldblatt who was overseeing this. So there are more hurdles, obviously, than just getting to closing, and we had to get through that, and it was not a walk in the park. Sam will tell you that. We had attorneys practically in, these are my words, fisticuffs in the back of the courtroom to get to that hearing, to the point where Judge Goldblatt had to dismiss. I'm going to blame it on the attorneys who had created too much heat in the room. I was the calm and cool one, which is unusual because I'm Irish and German. But again, to get to a close is not just getting it papered. There's a lot of things that can come up and arise. Neil spoke about post-close transaction obstacles, and Sam certainly had to live with it to the end. We closed the transaction in April. We had issues related to the 11 that went 6 months later. I can remember around the holidays, we were still dealing with issues from the original founder of the company on late night calls, on challenges. So I wanted to talk about a simple, cool product, what should be something that should be a transaction which is fun and cool for a wealthy buyer, but creates enormous complexities. Even if this was all going to be in the U.S., it would have been complex. But the cross-border barriers, the filing of the 11, which was necessary to keep this viable, to get to a transaction, just created a lot of issues along the way. Before we wrap, anything else you guys want to add to sort of close up? Neil, anything?
I guess I'll just add, we talked about the economic and legal challenges with working with international buyers on a transaction. I'd say the other part of it, which I'm sure and it doesn't have to be bankruptcy specific for this, but any international transaction just has the kind of the cultural differences as well. You've got the time zone, the language, and just the cultural business differences at the same time. From a time zone perspective, I think at one point we had a call where we were having guys from China, Germany, East Coast, Dallas, and the West Coast. So, in all spanning about 15 hours difference, and there was probably a half-hour window that could accommodate everybody within that whole time period. And that happened, with board meetings. Those were happening pretty regularly. There's a language barrier. There were translators on calls, or not formal translators, but CEOs who happen to know Chinese and English, translating for others, trying to understand it. People probably having some kind of ongoing translation device on their screen at the same time as these things. So just making sure everybody, and not just formally understanding what we're saying, but just translating it from how we might say something in the U.S. to how somebody might say it in China from a business perspective too. And just, I think culturally too, it was very different. Not only explaining the U.S. transaction structure system and M&A industry as well as bankruptcy system, but there's also seemed to be much more of a conservative approach from Chinese investors. They seem to be allergic to any publicity or any negative publicity about a company in bankruptcy, where we see that, Sam Tom and I living this day to day, we see bankruptcy as a tool that's beneficial to a buyer to help clean up liabilities and use it to move on to the next chapter of a company. They see it as a huge negative. You could have argued, and I'm sure Sam was pounding the table, that this should have been a bankruptcy probably a year prior to when they did it at the end of the day. So anyway, those are just a couple of the other international components to this that made this deal a little bit more challenging.
One last thing from me, and then maybe let Sam sort of wrap, or we'll take questions. We've got 4 or 5, 6 minutes, and I think lunch is out there. You guys are probably pretty hungry. But you talk about the administrative challenges, and Neil hit this up. I mean, just us alone. Neil's based in Philadelphia. I'm in Chicago. Sam was in L.A., Manhattan Beach. So coordinating us was pretty easy. But, we would do very intense board calls at 10, 11 at night, sometimes midnight. And we might be in this case, these guys, they're Lululemon gear. They don't make Lululemon for me. So I was in my sweats for these very important calls. But those are all things that create challenge in a transaction, right? Because you're dealing with people all over the world who you need to be fully engaged. And, it's no minor issue that you mentioned to get to that, Neil, and to get all the stakeholders on the same page. And Sam would often play, lead in getting everyone on the same page before we could talk about challenges to the transaction. Anything else you want to add before we?
Yeah, we have 5 minutes left, just I guess before I do a big wrap. Does anyone have questions? Just if there are burning questions in the crowd, we'd be happy to chat about them.
It sounds a lot of times we get pushback against going into a bankruptcy for a transaction, but it sounds like that in this case that there was a real return on investment, and it seems like, Neil, you were trying to get it done out of bank, and sometimes just impossible. So can you talk about how the bankruptcy process, there was it was really a positive return on investment and necessary to get this transaction properly to the finish line?
Yeah, it's a great question. I don't know, Neil, do you want to?
Sure, yeah, I can start. So when we were trying to do it out of court, we were trying to find third-party buyers, basically. The Chinese investor wanted to exit, and I think they had unrealistic views in terms of what that could look like. Yeah, we were working on a very highly manufactured deal that would transfer ownership but still provide some upside to the Chinese investor. And if you looked at it on paper, you'd say there's no chance in hell this is going to get done, right? There's just valuation just doesn't make sense for this company. But we went through all those different iterations. So bankruptcy, ultimately, I think that the Chinese investors decided, hey, we need to keep funding this, but we can't keep doing this with the ongoing litigation. We've got other equity investors too, and we're not going to keep putting money in pari passu with them. We've already put in a few $100 million worth of debt and equity, so we just want a clean balance sheet where we're owning this outright without all the other issues that are involved. And the only way to do that is with bankruptcy, or at least in this case, there was, right? There's many different types of insolvency transactions, Article 9, ABCs, others, but those leave you much more exposed than having a court order saying that you're buying the assets free and clear. So in this case, I think it didn't necessarily get them a return on their original investment, but at least in terms of investing going forward, this helped the investors clean the slate and know that they wouldn't have to deal with anything other than trying to grow the business.
Yeah, I'll just say one quick thing to add on and then get to the question, but we've all been involved in these transactions that just list on forever. People don't make decisions. They don't get to the end. And again, you have to be in a situation where there's a real bankruptcy problem, where there's some financial issue, but bankruptcy puts people on a clock. And I think that, again, Tom talked about the challenges, and there are challenges, and the expense, and there are expenses. But when you're in a situation where you need to get a deal done in order to get to the next door, bankruptcy puts people on a clock by saying, look, if you don't act now, someone else is going to show up. We're selling this asset at X date. And so that is an advantage. You know you can sell it. You will sell it. The market knows you're going to sell it. And that does, I think, help get ROI in situations that could otherwise just continue to list.
Just a quick question. We're all in business to make money, obviously, to get a deal, close a deal, hopefully do it efficiently. I'm just curious, knowing what you now know and how complicated it was and how much time it took, would you take this assignment on again?
Absolutely, and I actually glad that question I think kind of loans to where I wanted to go in terms of the closing, which is it is so important who you get into bed with, right? It is so important that you find a team that is able to execute a complicated transaction like this. So, I mean, just looking at this particular example, Tom talked a lot about the challenges, but I will say the first budget that we proposed to the investor was probably 30% over where we ended up. And Tom and his team took the fat out. They worked tirelessly day and night. They made sure that we hit budgets, we stayed on budget, we stayed on time, and that was critical. And sort of the same thing with the banking team. We targeted an investment that probably wouldn't have made anybody happy. And Neil and his team went to market with this really difficult asset. They worked tirelessly day and night across time zones, across cultural challenges, and we ended up at an auction that increased the purchase price by 30% over what we'd targeted. So there's like a 50% swing on what the economics of this deal was that is really directly attributable to the really strong and good work of my colleagues here. So I think you're absolutely right. Like, you don't want to take on every assignment, but even more importantly, you want to take on assignments with people that you know are going to perform and stick with you. And so that, to me, made all the difference.
Tom, how about you and Neil?
Yeah, we're out of time, but if you guys don't mind, I will jump in on this one because we don't do this. We all do this because we love what we do, but we also do it to make a living, get paid. And I won't tell you, we were day to day, week to week managing the professional fee as part of the DIP funding that came from the subsequent eventual buyer. And there were times when, we thought we may have to take a professional haircut, we may have to reduce the budget, but I'll argue, led by the three of us and some other really great professionals on Sam's team, Neil's team, and my team, we were very efficient, we worked really hard, we knew that we wanted to get paid, and so we had to play to that. And as Sam said, without the 11, we never would have got to the transaction. They were not mutually exclusive. And so it's a great question because we all want to get paid. We probably all had transactions where we didn't get paid what we had wanted to get paid. This is all preset. The budgets are what they are. There's no, Neil may have had a little kicker to get to a closing transaction, but the rest of us were hourly. And it's a real issue. And I'll just say it, the professionals that ran this were, top shelf, A-class, but none of us billed at $69 an hour, and so we had to be very effective that way. We had smart people doing smart things, and I think we had a really cohesive team to get that done, and we actually left money on the table on the professional fees, which is pretty impressive.
Interesting. Yeah, for me, 100%, I would have done this again, just because it was a successful outcome, right? If this was a deal that ultimately converted to Chapter 7 or liquidated otherwise, then I'd say we did a lot of work and didn't come to the outcome we wanted. But I think all of us I wouldn't say this is par for the course, but we know with distressed deals, with special situations, we're getting into complex situations. So it doesn't matter how we get there, as long as there's a deal at the end of the day that works for all parties, maximizes value, then it's worthwhile.
Interesting, because sometimes the most profitable deal is the one that you walk away from.
Absolutely. I'll sum it up unless Neil and Sam have anything else by saying this is kind of schmaltzy, and I'll say this to young turnaround restructuring professionals. We happen to have Sam's son here, Jacob, who's a young turnaround professional, restructuring professional, works in my world. And I'll just sum it up with this, and these are the things I think about on a deal like this when I go to bed at 1 a.m. and wake up at 6 a.m. And I tell the young people who are just trying to learn how to do a 13-week cash flow and learn everything they can about turnaround, restructuring, distressed transactions and transactions. The onion can be peeled back many, many layers, and you can squeeze a lemon and grind the rind, and that's what we did on this transaction.
We hope today's episode delivered actionable intelligence. We want to hear from the field. Share your questions or insights, leave a message on your favorite platform, or email us at editor@maadvisor.com. To secure your steady feed of premium M&A content, follow us on Spotify, Apple Podcasts, and YouTube, and subscribe to our M&A Alerts email newsletter. Find the links in the description below or visit us directly at our website at www.maadvisor.com. I'm Roger Aguinaldo, founder and CEO of the M&A Advisor. thank you for being part of the M&A Advisor community. Until next time, stay decisive, stay connected, and happy dealing.